I'm Dennis Tubbergen. You are listening to Retirement Lifestyle Advocates Radio. Glad you're listening in today. Hey, joining me on today's program in segments 2 and 3 will be Alasdair Macleod. Alasdair is the head of research at Goldmoney. He is also a prolific economic commentator and author. You can read his work at macleodfinance.substack. I'm going to chat with Alasdair about what's going on in the gold and silver markets, what's going on internationally, and how foreign entities and foreign countries view the U.S. dollar and what might lie ahead. This is going to be especially important information if you're doing some retirement income planning. It's a perspective that I believe you will not find many other places, so you'll want to stay tuned for that. This month in June, I do have a new special report for you. The special report is the Midyear Market Forecast. In the Midyear Market Forecast, which you can get by visiting requestyourreport.com, I give you my forecast for the rest of the year, and I also incorporate forecasts from 4 of my prior guest experts here on the radio program. So to get your report as well as some bonus information, visit requestyourreport.com. I'll be glad to send you the Midyear Forecast. Now, if you take a look at the recent economic news that was released, in particular the Chicago PMI. The Chicago PMI numbers plunged to what you can only call depression levels. Now, if you're not familiar with the Chicago PMI, that is the Chicago Purchasing Managers Index. And in short, it tracks business data. Now, if the reported index number is over 50, it indicates that the economy is expanding. If the index number reported is less than 50, then it means that the economy is contracting. Now, the most recent PMI number reported was 35.4. Now, it has been this low only 3 other times. One, at the time of the shutdown of the economy in much of the country in 2020, and at the peak of the financial crisis back in 2008, 2009. Those are the only other 2 times since 2008 that this number has been this low. Now, when you dig into the Chicago PMI report, not only is the reported number extremely low, when you look at the individual statistics reported by the Chicago PMI, you find that the business barometer is contracting. New orders fell at a faster pace. That signals economic contraction. Employment fell at a faster pace. That signals contraction. Inventories fell at a faster pace, also signaling contraction. Supplier deliveries, production, and order backlogs all down. Now, there was one thing in the report that rose, and that was prices. So not only do we have an economy that is contracting, we have prices that are continuing to rise. That, my friends, is the textbook definition of stagflation. So we have the economy contracting and prices rising. So the Fed, I believe at this point, the Federal Reserve, the central bank of the United States, now has itself painted into a corner. And in the third segment of today's program, I'm going to talk to Alasdair Macleod about this and get his take. But when you paint yourself into a corner, what does that mean? Well, there's something called the Dictionary of Idioms. Yes, such a thing does exist. And that dictionary defines painting yourself into a corner as to, quote, create a predicament or unpleasant situation for oneself whereby there are no or very few favorable solutions or outcomes. So if the economy is contracting, will the Fed cut interest rates to try to jumpstart the economy? And if they do that, doesn't that feed inflation? See, attempting to solve problem number 1, and that is what is a contracting economy, makes problem number 2, the inflation problem, worse. And if you try to solve problem number 2, the inflation problem, by keeping interest rates up, because our economy is addicted to artificial stimulus, artificial conditions, cheap money, it exacerbates the inflation problem. Now, one need only look as far as the Chicago Purchasing Manager Index to see that that is where we are headed. Now, when you look at the gross GDP numbers, when you look at the gross domestic product numbers that are reported, it has the economy growing. Now, I'll chat with Mr. Macleod about this in segments 2 and 3. However, gross domestic product is really not all that useful when determining whether or not the real economy is contracting or expanding. See, right now, government deficit spending, and I'm talking about U.S. government deficit spending, this year will be about 9% of the entire economy. We're on track for about a $2.4 trillion deficit, despite the original projections of about $1.5 trillion. Now, that probably doesn't surprise anyone that the deficit is going to be larger than the politicians and the pundits first reported. Now, to get a real clear picture of the economy and economic growth, you have to pull out government deficit spending, because when the government spends money, it adds to GDP. And the government spending is added to GDP, whether that spending comes from maybe tax revenues or whether that spending comes from currency that is created. The point is, if it comes deficit spending, spending money that you don't have, is no more economic growth than you going to take a cash advance on a credit card is income. It's not income. You're borrowing against future production. So government deficit spending is cash flow, but it's not growth. Now, I'll ask Alasdair Macleod about the piece that he recently wrote in the next segment, but I want to give you just a bit from that piece. He said, quote, Margaret Thatcher said something on the lines that socialism fails when it runs out of other people's money. It's a great quote. Alasdair says we appear to have reached that point. Aggressive tax policies are now reducing their yield. We're now sliding down the after end of the Laffer curve. Now, if you're not familiar with the Laffer curve illustrates a theoretical relationship between rates of tax and the resulting levels of tax income that the government collects. So if you have a 0% tax rate, the government collects 0 in taxes. If you have a 100% tax rate, the government collects 0 in taxes because people and businesses quit producing. But somewhere in the middle, there is an optimum percentage rate of taxation that results in maximum government tax revenue. Alasdair says we seem to be going past that point. Certainly we're seeing that now when you look at the report from California that recently raised their fast food minimum wage to $20 an hour. Rubio Restaurants is now closing 48 stores as a result. And you're seeing this now take its toll on the economy. Now, Alasdair said this, with mandated welfare and other expenses increasing, hope that economic growth will reduce budget deficits are misplaced. Estimates for budget deficits in nearly all high-tax jurisdictions will turn out to be overly optimistic. This has important implications for inflation, which are currently being ignored by everyone from governments to central banks and down to investors. Now, Alasdair points out that we will likely have here in the United States pushing a $2.5 trillion deficit by year end. He says $2.4 trillion. I suspect he will be correct. However, Alasdair makes this point, and I'm going to ask him about this in the next segment. He said that he suspects the budget deficit could turn out to be even worse, partly because it's an election year, partly because the debt ceiling is not in place until January 2025, and partly because the productive economy is already in recession. He said this last assumption that the productive economy is already in recession is based on simple arithmetic. If, according to the Bureau of Labor Statistics, gross domestic product grew by 4.5% in the year to last March, when you allow for a budget deficit injection of 9%, that means the private sector actually contracted by 4.5%. That means the private sector is already in recession. So this, in my view, is the Fed's big conundrum, or where the Fed is painted into a corner. Inflation is continuing, and deficit spending by the government is one of the main reasons why. At the same time, the real economy, absent this deficit spending, is contracting. If the inflation problem is to be effectively attacked, the Fed will be required to keep interest rates where they are at the very least, likely raise them. And the Washington politicians will have to balance the budget or come a lot closer to doing that. On the other hand, if the Fed decides to boost the economy, they feed inflation. So I would invite you to get my mid-year market forecast to get another perspective, to get some direction. Go to requestyourreport.com. I'll be glad to send it to you. And be sure to stay tuned, because on the other side of the break, I'll be having a chat with Alasdair Macleod about this very topic. Stay with us. Welcome back to RLA Radio. I am your host, Dennis Tubbergen. Joining me once again on today's program is returning guest, Mr. Alasdair Macleod. Alasdair is a very bright economic researcher. Always look forward to having him on the program. You can read more of his work at macleodfinance.substack. Alasdair is the head of research at Goldmoney, and you can learn more about Goldmoney at goldmoney.com. Alasdair, thank you for joining us again, and welcome back to the program.
That's very much my pleasure, Dennis.
So, Alasdair, I read with a great amount of interest a piece that you wrote recently about how inflation will continue, interest rates will move higher. I'd like to dig into that a bit, but you said something in that piece that I would love to have you share with the listeners, and that is that the real economy is contracting here in the United States when you take into account government spending. I thought that was a really interesting perspective. Could you expand on that?
Yes. Basically, GDP is actually a nonsense statistic. It's useful to government because it gives them an indication of the tax base. But for the rest of us, we confuse growth, in inverted commas, with progress. The two things are not the same. You cannot measure progress. Growth in terms of credit in the economy, of course, you can measure, and that is precisely what GDP is. So there's obviously good credit and there is useless credit. And unfortunately, government credit is useless. So when the government spends in excess of its revenues, in other words, a budget deficit, the difference is basically made up of an expansion of the quantity of currency. And the consequence of that is twofold. First of all, you see an increase in GDP, which can be mistaken for economic growth, which of course it isn't. And the second thing is that it dilutes the purchasing power of existing currency in circulation. So this is why when you get a budget deficit, it tends to feed pretty much directly into inflation. And the inflation, of course, is something that gradually works its way through the economy to the point where suddenly you find that the last person, if you like, to get this new currency in circulation finds that its purchasing power has actually diminished. This is reflected, of course, in rising prices. So that was the point I was really making.
Terrific point. So, Alasdair, if I could take that a step further, please correct me if I'm wrong, but are you inferring that inflation will continue until such time as the U.S. government gets its fiscal house in order?
Yes, indeed. That is precisely what I'm inferring. But there is another aspect of this which we mustn't overlook, and that is a fiat currency depends on its value for its value in the faith that it actually is, a legitimate currency with a certain purchasing power. Now, I don't see the faith really changing that much in initial stages of a problem in a domestic economy, so that American users will not be aware of this. But if you're a foreigner, you're looking at the dollar from a completely different viewpoint, and you're thinking, is this something I really want to have or not? And this is why gold and silver prices are rising. It's not that they're rising. It's just that foreigners are, at the margin, turning sellers of dollars and also sellers of dollar debt, which is a very, very important point, particularly when the US government relies on, if you like, for its funding, on a reasonably large segment of foreign demand for its debt. That demand is now diminishing, and we've seen for some time now that China, in particular, which is the largest single identified holder. I mean, I know in total the Japanese hold more, but that's pension funds, insurance companies. It's not the government. But in the case of China, we're looking at the government's holdings of US treasuries. They are selling. Why are they selling? They're selling because they don't want the dollar anymore.
Alasdair, I read a piece that I think said that the Chinese government sold $75 billion in U.S. treasuries in the first quarter of 2024, and the decline in U.S. treasury holdings was more than offset by an increase in their official gold holdings. Can you speak to that, and do you see that as a trend that's going to accelerate from this point on?
Well, you have to put yourself in the shoes of the PBOC. Government policy is to reduce the use of the dollar within China and between China's trade partners. And these are particularly more or less the whole of Asia, and also the members of BRICS and BRICS Plus, who are not in Asia. So the background basically is that as far as the PBOC is concerned, they want to reduce their dollar reserves. There is no point in them holding dollar reserves so long as the government has this policy. But what do they sell the dollars for? Well, if they sell the dollars for another currency, that's not going to really work either. So the only thing really that they can sell the dollars for is gold. And that explains precisely what the PBOC is doing. It is selling dollars to buy gold. But principally, driving this isn't necessarily the purchase of gold. It's getting rid of the dollars. And this is a very important point, which I think very few people have hoisted on board.
Alasdair, when you take a look at BRICS, Brazil, Russia, India, China, South Africa, they added Saudi Arabia, they've added United Arab Emirates, Iran as of the first of the year. There's talk about a gold-backed digital currency that BRICS wants to roll out. As obviously a direct competitor to the dollar in international trade. Where do you see all that presently, and what do you think the timeframes might be, if you could be so bold, moving ahead as to when that actually might come to fruition, if it will?
Well, a little bit of history on that one. The Russians proposed it, and it didn't even make the agenda in the BRICS meeting in Johannesburg last August. I think that the opposition to this concept came from India, which of course is a very populous member of BRICS. India is essentially Keynesian in its economic approach, and also it doesn't really want to upset the West, because the West is still a very, very important part of their global trade. China also decided not to support it, I think for a very good reason, and that is that they didn't want to undermine the dollar. They didn't want to be accused of crashing the dollar. China is walking a tightrope on this one, because they want to get rid of the dollar, but they don't want to be blamed for the end of the dollar. But inevitably, their policies of getting rid of the dollar will lead to the end of the dollar. If they had accepted the idea of a gold-backed trade settlement currency for BRICS, and it would also have applied for the Shanghai Cooperation Organization, then that would have probably crashed the dollar a lot more immediately than if they hadn't. As it is, I think that the Chinese are now in a defensive position, So they will eventually have to link the yuan to gold. So I think that will happen in the fullness of time. But meanwhile, instead of using a gold-backed trade settlement currency, what the BRICS organization are doing is they have agreed to accept each other's currencies. Now, that doesn't mean to say that on each deal, Saudi Arabia takes Kenyan shillings. No, they're not going to do that. There are basically three ways in which these settlements occur. If you're dealing with China, you probably take Chinese yuan. If you're dealing with, say, the Saudis are exporting oil to Kenya, then they will either insist on having, if you like, a locked-in rate between the rial and the Kenya shilling. In other words, guarantee the value of the Kenya shilling in rials. Or if that is not acceptable to both parties, then the answer is that they will insist, I think, on Kenya settling in Chinese yuan. So I think the interim period before we get returning to a proper gold standard for Asia and China and Russia and so on and so forth, is that the yuan will effectively replace the dollar as the international reserve currency for BRICS and also for the Shanghai Cooperation Organization. But it will require to be, if you like, the value will require to be stabilized as the dollar goes down, because when the dollar goes down, it'll take every other fiat currency with it.
Alasdair, we've got just a couple of minutes left in this segment. I'd like to remind our listeners that you can check out Alasdair's work at MacleodFinance.substack. That's MacleodFinance.substack. And Alasdair, if you're just joining us, is the head of research at Goldmoney. And Alasdair, now since I have talked a bit, we have about a minute and a half left in this segment. Would you like to explain to the listeners what Goldmoney is and why they might want to learn more?
Yes, Goldmoney basically stores gold and physical gold, silver, and platinum group metals on behalf of members of the public outside the banking system, and it is held in custody for the individuals. So the property in the precious metals remains with the customer. This is a very important point to understand. And there is no conflict of interest in the sense of it being taken onto the balance sheet or relying, if you like, on the organizations holding sufficient gold to back its obligations and so on. It is really a very, very simple model. But what it does is it secures large amounts of gold and silver outside the banking system in fully insured vaults around the world at the customer's choice.
Well, I'm chatting today with Mr. Alasdair Macleod. You can learn more about his work at MacleodFinance.substack. That's MacleodFinance.substack. You can learn more about Goldmoney at Goldmoney.com. I'll continue my conversation with Alasdair when RLA Radio returns. Stay with us. I'm Dennis Tubbergen. You are listening to RLA Radio. I have the pleasure of chatting once again today with returning guest, Mr. Alasdair Macleod. Alasdair is the head of research at Goldmoney. You can learn more at goldmoney.com. And I am an avid follower of Alasdair's work. You can do the same by visiting MacleodFinance.substack. That's MacleodFinance.substack. And Alasdair, you made a statement since we do have listeners all around the world, but primarily our listeners here are here in the United States. You had suggested that eventually the Chinese yuan will at least somewhat displace the dollar in terms of an international trade currency, and that might spell the end of the dollar as we know it. What does that look like for an American citizen when that happens? And, we've been talking about this for a couple of years now. It almost feels like we're watching an accident in slow motion. At least that's the analogy that I like to use. Can you comment a bit?
Well, yes, it is a bit like that. I would agree, Dennis. There are rarely at any one time two views on a currency. There is the domestic view, the people who use it for day-to-day transactions, and there is the foreign view. The people who are unfortunately last to wake up to what's happening to their currency is usually the domestic users. And we are, I think, really on the beginning of the slide of the dollar. And this is what gold is signaling, with gold rising really rather sharply over the last 6 weeks or so. The reason it's gold that is rising is because the dollar is the number one fiat currency in the world. Of that, there is absolutely no doubt. And if the dollar goes down, then all other fiat currencies will suffer a similar fate. I mean, the idea that, a country can run its finances effectively under a fiat currency regime and be insulated from this is, I'm afraid, not true. Dollar goes down, all the other fiat currencies go down. The reason for this is that legal money is and always has been, going back from in Roman times and all incorporated in everyone's common law, is gold, silver, and copper, if you like. And so what are the Chinese doing? They're accumulating gold in preference to dollars. They're also hoarding copper, which I think is interesting. I don't know that they're doing that for monetary purposes. I would suspect not. But the point is that the last people to actually understand what's happening to their currency are the domestic Americans. They're sitting there perhaps thinking that things aren't right, it doesn't look good, gold is rising, whatever. But they haven't actually worked out that what is happening is that their currency is facing a collapse. Now, at this stage, this is very important because looking at what the markets expect, they expect interest rates to fall. But if you have falling interest rates, that implies that the currency actually will maintain its purchasing power. So that is very much a domestic view. We now have evidence of a recession, and I've been talking about this for some considerable time. It's definitely happening in the sense that if you look at the job openings and all the rest of it, things are not looking good. And of course, the Keynesian response to this is that the Fed should reduce interest rates. I think in an article this morning from my Substack, I quoted Citicorp, which a researcher there who said that the Fed should reduce interest rates in July and continue reducing them every month into the middle of 2025. I mean, he's talking about getting back to zero interest rates. This is absolutely crazy. With inflation raging, with foreigners not prepared to buy dollar debt, there is only one thing that's going to happen. And that is that the dollar is in crisis. And in a sense, what the Fed does is entirely secondary. They can just make it collapse even more rapidly than it would otherwise. This is not a good situation. And I think, I understand why it is domestic users don't appreciate what's happening to their currency. But I would urge them to think about this very, very seriously. Don't accept what the establishment is trying to tell them, that it's all right, we're going to reduce interest rates so everything will be saved. Bonds will go up and equities will go up. That is absolute dangerous rubbish.
Alasdair, it seems to me the Fed, as you said, what they do is really secondary, but they seem to be painted in the proverbial corner here. If they reduce interest rates, it probably further accelerates the decline of the dollar. If they try to hold firm to attempt to get inflation under control, the already weak economy tanks. I mean, this is really a no-win situation, isn't it?
Yes, I would agree. And in the past, of course, what they would probably consider is banning ownership of gold. But, I think the horse has bolted from that stable. If they tried to go down that route, then I think it would actually drive gold prices far higher because it would scare the living daylights out of every foreigner holding dollars. That is for sure. We've also got other things which are likely to happen. We're not going to see prices fall in a recession. And the reason for that is, as I've try to get the message over that the purchasing power of the dollar is fundamentally flawed, is going down. The next thing we will see, and we had this in the 1970s, with which I would compare this time, in many respects. The next thing we will see price controls. I'm just waiting for those to come in. You will see import controls as well. That's coming in anyway. We can see that, but that ends up just driving up prices. So, basically, they're going to try. I think the authorities are going to just try and sit on the evidence that this is horribly going wrong as much as they can, legislate accordingly. But it won't cure anything. It'll just make things worse. And, you said earlier that everything we do seems to go wrong. Yeah, it's going to continue to do so, I'm afraid, Dennis.
Alasdair, when you mentioned price controls, I'm reminded of a piece I read that Richard Nixon was convinced by his advisors prior to the 72 election to throw price controls out there. And private conversations among the advisors said, we know this isn't going to work, but this is an election year, and the electorate essentially won't know they don't work until after the election. Can you see history repeating itself?
Yes, absolutely. I mean, politicians know it doesn't work, but of course, a political imperative always trumps an economic reality.
So, Alasdair, just to maybe not to add more bad news to what's already arguably maybe a bit of a gloomy conversation as far as our listeners are concerned, but Janet Yellen and the Social Security program's trustees here in the United States, as well as two of our department secretaries, signed an official report that said Social Security will officially be broke in less than 9 years, and that's based on some pretty rosy assumptions. Doesn't the rubber have to meet the road here sometime in the next 2, 3, 4 years with that looming on the horizon, with deficit spending that's projected to probably be, I think we're on track for probably $2.5 trillion this year. That's before an election year goodie bag that may or may not be passed. When does all this come to fruition?
Well, people keep on quoting Hemingway, going bankrupt slowly at fast and then suddenly. We just don't know the timing, Dennis. But I have a horrible feeling this is going to happen sooner rather than later. I'm just watching what the Chinese are doing. I mean, one thing that's fascinating is that the Chinese savers, they put aside every year something like $6 trillion equivalent. Now, that's 75,000 tons of gold at current prices. What else do they buy? Property? No. The stock market? No, because they've had 3 years of a bear market. I know it's been looking a little bit better this year, but not enough to convince the ordinary person. So they've been putting it into bank accounts, and they pick up 3% on what's called a certificate of deposit. It means something slightly different to us, but that's what the Chinese call it. That's about it. So they're now looking at gold. And we have seen how gold and silver basically have been cleaned out of Western markets. Now, the buying power of Chinese savers is absolutely enormous. I mentioned it's the equivalent of 75,000 tons of gold. Now, there just isn't that gold available. You're lucky if you can get 100 tons nowadays. So, but interestingly, if you've got at least 500 or 600 yuan, you can open a gold account with your bank, and your bank will go out and buy the gold for you. So lots of people are doing that. And of course, this doesn't come out of the Shanghai Gold Exchange statistics because it is kept within their vaulting system. So there is a substantial and growing slug of gold ownership for savers, which is all locked up in the SGE's vaults. We just don't see it in the statistics. And as well as that, I understand that they, every day they queue around the block buying physical gold, little sort of 24 karat jewelry, and small bars and so on. The other thing is that, of course, the Chinese love to speculate, and those with a certain amount of cash, as it were, just go into the futures market and they punt wildly. Now, none of this really helps the Western bullion banking system, because it has been drained of this stuff. I find that people in the bullion banks are turning around and saying, well, of course, the Chinese are huge speculators and all the rest of it. But hold on a minute. If you're going into the futures market in Shanghai and you're buying gold, you're probably looking at what the People's Bank of China is doing. I mean, effectively, you're following official policy. Is this speculation? Well, of course it is. But I tell you what, there's a lot more speculation to come on the bull tack.
Well, the clock says we have to leave it there. My guest today has been Mr. Alasdair Macleod. I would encourage you to check out his work at macleodfinance.substack. That, again, is macleodfinance.substack. You can learn more about Goldmoney at goldmoney.com. Alasdair, thank you for joining us today. I'd love to have you back down the road. Always tremendously enjoy our conversation. So thank you.
Very much my pleasure, Dennis, and I look forward to coming back.
We will return after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen, and thanks again to my special guest today, Mr. Alasdair Macleod, for joining me. If you're just tuning in, I have available for you a brand new June special report. It is titled The Midyear Forecast for the Economy and the Investing Markets. I'd be glad to send you a complimentary copy of this special report, available only during the month of June. All you need to do is visit requestyourreport.com and let me know where to mail the report. I'll be very glad to do so. Again, requestyourreport.com to get your mid-year forecast issue of where the markets and the economy may be going in the second half of this year. Well, on today's program, I talked a bit about the outcome of a stagflationary environment moving ahead. Talked with Alasdair Macleod about the dollar and what's going on around the world as far as fiat currencies are concerned, as far as precious metals are concerned. And today, on the fourth segment of the program, I want to talk a bit about one of the side effects, one of the outcomes of inflation. Now, as you might imagine, if you think about it, inflation really benefits those that have assets. If you own real estate in an inflationary environment, the devaluation of the dollar inflates the value of real estate. That has also been true to this point with stocks. It's also been true with gold. Inflation drives up the nominal price of your property. Now, on the other hand, if you don't have assets and you find yourself living paycheck to paycheck, inflation is a killer. You pay more for groceries, you pay more for utilities, you pay more to have your car repaired. And certainly when you look at the data, when you look at some of the news stories that are being published, they point to a widening wealth gap in the United States. Now, the St. Louis Federal Reserve Bank did a survey, and the survey concluded that credit cards have become the new emergency fund for many consumers. And on this program in the past, we've talked about the fact that consumer credit card debt is now about $1.4 trillion, which is more than the annual outlay for all Social Security benefits. That alone is mind-boggling when you think about it. But back to this St. Louis Federal Reserve Bank survey, it found that more than half of U.S. households held credit card debt in 2022. It also found that lower income households are disproportionately burdened by credit card debt. And those at the bottom of income distribution, lower income households, tend to have higher credit card debt ratios. Probably because they have less cash and savings, and they have fewer desirable loan choices. They don't necessarily have a home equity line of credit, so they're resorting to credit cards. And the survey concluded that for many Americans, credit cards have become the new emergency fund. So while we have many at the lower levels of income struggling and adding to their credit card debt, and we have many lower income households struggling with debt and meeting their day-to-day living expenses, at the other end of the spectrum, the wealthy, for the most part, are getting wealthier. In fact, there was a story published on CNBC this past week that really drove this point home to me. The wealthy in Palm Beach, Florida, are now in bidding wars for household help. Now, get this. Starting salaries for housekeepers in Palm Beach, Florida, are now at $150,000 annually, plus benefits. Let me give you just a bit from the article. Housekeepers in Palm Beach and South Florida are cleaning up, with salaries often topping $150,000, and bidding wars between mansion owners are becoming common. This is according to staffing companies that staff household help. So this mass wealth migration to Florida from New York and from other high-tax states has created record demand for household staff in many wealthy Florida communities, especially Palm Beach. Demand for butlers, although butlers are now called hospitality managers or estate managers, as well as nannies, chefs, drivers, and personal security, have all surged according to staffing agencies. These are the agencies that help households hire these people. It's the shortage of housekeepers, though, that has created the biggest mess, the biggest problem for wealthy homeowners. Talk about a first world problem, huh? Many of the wealthy who went to Florida bought big homes, and now they need people to clean them. Hotels, resorts, and businesses are competing for a limited pool of cleaning staff. Now, the result is this. Typical pay for housekeepers has gone from about $25 an hour in 2020 to about $50 an hour today, according to these agencies. In Palm Beach, housekeepers with experience in wealthy homes are making between $120,000 and $150,000 a year, along with 401k plans, along with health care benefits, and overtime. Now, there is a woman quoted in the article by the name of Melissa Cito. She is the founder of Lily Pond Services, a staffing agency. She told the story of a Florida client who was hoping to hire a housekeeper for $75,000 a year, but this household ended up paying $110,000, which was reasonable for the market. Cito says she knows one head housekeeper in Palm Beach who makes $250,000 a year, including overtime, and this housekeeper travels with the family to their various homes. Now, certainly those two stories, taken back to back, illustrate that the wealth gap has widened. Now, as I mentioned in the first segment, I believe we will be moving into a stagflationary environment. I believe it will mean that if you're planning for retirement and you're looking to develop a retirement income model, you'll need to take this into account, because this environment will be a much different environment in which to retire than any environment we've experienced in the recent past. So to that end, I'd like to invite you to get my mid-year market forecast. You can go to requestyourreport.com, and I'll be very glad to send it to you along with some bonus information. Again, go to Request Your Report. You'll get the mid-year market forecast. You'll also get a couple copies of my books to help you plan as you move toward retirement. That's my program for this week. Hope you got something you can use. I will be back again next week.